And investors, they're looking ahead to the open with disappointing earnings results from Dell, another big tech heavyweight, fresh on their minds. As you know, the company reported results yesterday, missed profit expectations, and Robert Hagstrom from Legg Mason is up 40% this year, betting on some of the big name tech stocks, and he's here to tell us if they have more room to run. And Robert, I just want to say on the outside, though, you don't own Dell.
That's right, Betty.
But what we saw from the earnings report, does that raise any red flags for you in the sector?
Yeah, I don't think so. I mean, if you look at what's going on, your headline on Microsoft, you're seeing a lot of great sales on the Windows 7. If you look at HP, IBM, and others, I think the tech sector is very, very healthy. Sometimes people's expectations get a little ahead of a stock or an earnings estimates, but I think the tech globally is in very good shape.
Now, you bet on the big name tech shares, but some have come on our program and said, look, if you want to be in tech, some of the places you want to be are in the smaller cap stocks because these are the ones that are likely going to be acquired as we're seeing more M&A activity in the sector.
Yeah, well, I don't disagree with that, and we own some of the kind of the mid-cap names. Fair disclosure, we own Red Hat, Autodesk, which might fit that profile. But I think it would be a mistake to try to go out and pick stocks that you think are going to be taken out. You want to pick good stocks that are good businesses that are going to earn a good return for your investors. Do I expect that there'll be more M&A in this space? Absolutely. But trying to pick stocks for M&A is a real tough game.
Hey, Robert, it's Adam. While we're talking tech, let's talk EMC. Obviously, storage is the whole issue there. Is storage really one of the big issues, maybe the biggest issue, as we're talking about traditional businesses trying to grow and use the internet?
Yeah, I think the server business, Adam, I think you're exactly right. I think the server business globally, I'm talking globally, is a secular industry, growth industry for many, many years to come. Much of that, Adam, as you well know, is going to come from cloud computing, which is probably going to be one of the higher growth areas in technology. And as you outsource more of your technology needs and your storage needs, people like EMC are going to be one of the great beneficiaries there.
And I tell you what, for people who don't understand cloud computing, can you just give us the quick two-bullet explanation?
Yeah. It's just basically saying that you can outsource your software and storage needs to a provider cheaper than you can run it on your own. Today, most people run their own servers, buy their own software, have their own IT people. But what is happening in this space, whether it's Microsoft, whether it's Google, Amazon being the world's largest, people like that, what you're seeing is a move towards outsourcing your computer needs. So email, other things that you've been doing in-house, you'll slowly start to do that outside with a provider cheaper than you can do it on your own.
Robert, in the time that we have, I mean, last time we talked, I believe it was back in August, you said that you would possibly be going more offensive in the markets if you saw economic growth sustainable. Your thoughts now?
Yeah, we're still on the offensive side of the board. We think there's tremendous value in the technology. If you look at free cash flow yields, they're the cheapest we've ever seen them. Very attractive space. If you look at the economic returns, we are starting to get positive economic returns. The debate, Betty, as you know, is just what is the magnitude of those returns. We're kind of in that 3% GDP growth here. You know, does the 3% grow faster to 4, 5, and 6, or is it going to muddle here in the new normal as described by Bill Gross and others?
Well, do you buy into that? Do you buy into the new normal?
Yeah, absolutely. Well, I think the data would support that, but I think we also have to be aware that a V-shaped recovery is not out of the question. We have to see where the data leads us. But remember, even in a new normal environment of 2 to 3 to 4% growth, growth stocks will do extremely well. Growth will be the scarce resource. Growth stocks that are providing good revenue growth are going to be very, very attractive. Stock pickers can win in a new normal.
Okay. All right, Robert, good to have you back, and nice to see you again, Robert Hagstrom of Legg Mason.